2. Have you ever opened a trade and noticed that you were already in a small loss the second you entered? You didn't even do anything wrong. The market didn't really move. And still, your trade started negative. If that has ever confused you, this video is going to clear everything up. Today, we're talking about spread and commission, and most importantly, how brokers actually make money. Because once you understand this, trading will make a lot more sense and you'll stop feeling like something is secretly working against you. Before we go deeper, if you're serious about learning Forex the right way, make sure you like this video and subscribe to Forex Trading Rocket Signal. This channel is built to simplify Forex step by step, especially for beginners who want real understanding instead of hype hits. Subscribe now so you don't miss the next lessons, because everything connects. Now let's start from the very beginning, in the simplest way possible. In Forex trading, every time you open a trade, you see two prices. One is the buy price, and one is the sell price. The small difference between those two prices is called the spread. That's it. Spread is simply the gap between the bid price and the ask price. Imagine you want to buy EUR/USD. 2. The broker shows you 1.1002 sell and 1.10022 buy. That tiny difference of 0.0002 is the spread. In most currency pairs, that difference is measured in pips. So in this example, the spread is 2 pips. The moment you enter the trade, you are down those 2 pips. Why? Because if you bought at 1.1002 and immediately closed the trade, you would sell at 1.1000. That difference is the broker's spread. Now, here's the important part. That spread is one of the main ways brokers make money. Instead of charging you directly every time, they build their fee into that small difference. It may look tiny, but when thousands or millions of trades happen every day, that small difference becomes very profitable for brokers. Some brokers operate only on spread. These are often called spread-based brokers. Others use something called commission. Commission is a fixed fee you pay per trade, usually based on lot size. For example, a broker might charge $7 per standard lot round turn. That means when you open and close a one-lot trade, you pay $7 total as commission. So, what's the difference between spread and commission? With spread-only accounts, you don't see a separate fee. The cost is hidden inside the price difference. With commission accounts, spreads are usually much tighter, sometimes close to zero, but you pay a clear fixed fee per trade. Let's break this down in a simple example. Imagine you are trading one standard lot on EUR/USD. On a spread-only account, maybe the spread is 2 pips. If 1 pip equals $10 on a standard lot, then 2 pips cost you $20. That's your trading cost. On a commission account, maybe the spread is only 0.2 pips, which is $2. But you also pay $7 commission. So your total cost might be around $9 instead of $20. In that case, the commission account is cheaper. But here's where it gets interesting. Costs depend on how you trade. If you are a scalper who opens many trades per day, lower spreads matter a lot. Even small differences can affect your profit over time. You are a swing trader who holds trades for days. A few extra pips may not matter as much because your targets are larger. Now let's talk about something many beginners don't realize. Spreads are not always fixed. Sometimes spreads are variable. That means during normal market conditions, spreads are small. But during major news events, low liquidity hours, or high volatility, spreads can widen. Suddenly, that 1 pip spread becomes 5 pips or even more. Phew. Not aware of this, you might enter a trade during news and wonder why your position instantly drops steeper than expected. This is why understanding spread is not just about cost. It's also about timing. Trading during major economic news can be expensive if spreads widen. Smart traders always check market conditions. Another important thing to understand is that brokers are businesses. They are not charities. They provide you with a trading platform, liquidity charts, and access to the Forex market. In return, they earn through spread, commission, or sometimes both. That does not automatically mean they are against you. A regulator broker earns from volume, not from your loss. The more you trade, the more small fees they collect. However, you still need to choose your broker wisely. Look for transparency. Look for clear commission structures. Look at average spreads on the pairs you trade most. A small difference in spread can make a big difference over hundreds of trades. Let's also connect this to risk management. Many beginners focus only on win rate. They ask, how many trades do I need to win? But they forget about trading costs. Even a strategy with a 60% win rate can struggle if spreads are too high. That's why professional traders always calculate net profit after costs, not just raw pip gains. A Forex Trading Rocket Signal. We always say this clearly. Trading is not just about entries and exits. It's about understanding the full picture, including costs. When you understand spread and commission, you trade smarter. You stop being surprised by small losses at entry. You plan better targets. You choose better trading hours. Here's something powerful to remember. The spread is the price of participation. It's the cost of entering the market. Jess. Like any business's operating costs, trading has transaction costs. The goal is not to avoid them completely, because that's impossible. The goal is to manage them intelligently. Now think about this. If your average trade target is 5 pips, but the spread is 3 pips, you're giving away a big portion of your potential profit. But if your average target is 50 pips, a 2-pip spread becomes much less significant. That's why strategy and cost structure must match. As we move toward the end of this lesson, I want you to remember something simple. Spread is the difference between buy and sell price. Commission is a fixed fee per trade. Brokers make money through these mechanisms. And your job as a trader is to understand these costs, calculate them, and include them in your plan. If this video helped you understand something that used to confuse you, let me know in the comments. Tell me, are you using a spread-only account or a commission account? And do you know your average trading cost per trade? If you don't, that's your homework after this video. Also, share this video with a friend who is learning Forex. Many beginners lose money simply because they never learned how brokers make money. Don't let that be you or someone you care about. Make sure you stay connected with Forex Trading Rocket Signal for the next lesson, where we'll continue building your foundation step by step. The more you understand the basics, the stronger and more confident you become as a trader. Keep learning, stay disciplined, and I'll see you in the next video.